there's a strong possibility that over the next 12 to 18 months, we'll see one of the most important shifts in the global economic cycle in decades. Not 5 years from now, not some distant future event, possibly much sooner than most people expect. And this isn't about predicting a dramatic crash on a specific date. It's about recognizing patterns, the kind of patterns that tend to show up near the end of long-term debt cycles, cycles that don't happen every recession, but maybe once every 75 to 100 years. Right now, many of those late cycle indicators are quietly building. And historically, when these long debt cycles turn, wealth doesn't just disappear, it transfers from people positioned for stability in normal times to people positioned for stress in abnormal times. That's why this matters. Let me tell you a story. In early 2006, I had a conversation with a 54-year-old engineer. I'll call him David. David had done everything right. He wasn't reckless. He wasn't chasing get-rich-quick schemes. He saved consistently for over 30 years. By his mid-50s, he had built a portfolio worth about $1.8 million. He followed the traditional advice almost perfectly, roughly 60% in diversified stock funds, about 40% in bonds. He worked with a reputable wealth management firm. He paid substantial annual fees for professional guidance, and he was told the same thing most long-term investors are told: stay diversified, stay invested, stay the course. When we spoke, I explained that we were deep into a credit expansion. Housing leverage was historically high. Banks were holding increasingly complex mortgage-backed securities. Debt was rising faster than underlying income growth. The system looked stable on the surface, but structurally fragile underneath. I suggested gradually reducing exposure to risk assets and increasing liquidity. His advisor disagreed. He showed David historical charts proving that markets recover over time. He explained that diversification protects against downturns. He emphasized that trying to reposition before a downturn was market timing. So David stayed the course. In 2007, markets kept rising. His portfolio climbed above $2 million. It looked like the conventional wisdom was working. Then 2008 arrived. Over the next 18 months, his portfolio fell by more than 50%. 2 million became roughly 1 million. Yes, the market eventually recovered, but time is not symmetrical. At 35, you can absorb a 50% drawdown and wait a decade. At 56, approaching retirement, the math is very different. He delayed retirement by years, not because he made reckless bets, but because he was positioned for growth at a point in the cycle when capital preservation mattered more. This isn't about fear. It's about sequence risk. The risk of large losses just before or during retirement can permanently alter financial outcomes. And that's why understanding where we are in broader economic cycles is so important. The economy isn't random chaos. It behaves more like a machine. A complex machine, yes, but still governed by identifiable forces. There are three primary drivers that shape long-term economic movement. The first is productivity growth. Are we producing more goods and services per person over time? Innovation, technology, education, efficiency, these push living standards higher over decades. The second is the short-term debt cycle. This is the familiar boom and bust pattern we see every 5 to 8 years. Credit expands, spending increases, asset prices rise, central banks tighten policy, credit contracts, recession follows, then easing begins again. This cycle repeats regularly. But underneath both of those sits something far larger and far slower: the long-term debt cycle. Over decades, debt accumulates across governments, corporations, and households. Each short-term cycle begins with slightly more leverage than the last. Eventually, total debt levels grow so large relative to income that servicing the debt becomes increasingly difficult. At that stage, the system becomes constrained. Interest payments begin consuming a larger portion of government budgets. Corporate balance sheets become more sensitive to rate changes. Consumers feel pressure from rising borrowing costs. Historically, when debt burdens reach extreme levels relative to GDP, policymakers face limited choices. They can allow widespread defaults, they can restructure debts, or they can reduce the real value of debt through inflation and currency debasement. Modern economies, more often than not, lean toward the third option. Not openly, not dramatically at first, but gradually through monetary easing, liquidity injections, yield curve management, and various forms of financial repression. The effect isn't immediate collapse, it's erosion. The erosion of purchasing power, and that's the real risk in late-stage debt cycles. Not necessarily a sudden crash, but a slow degradation of real wealth for portfolios positioned purely for traditional growth. Right now, global debt levels, especially in developed economies, are historically elevated.
Government debt to GDP ratios are near levels typically associated with wartime financing. Interest expenses are rising as rates have increased from historic lows. That doesn't guarantee a crisis, but it does shift the balance of probabilities. And when probabilities shift, positioning matters, because late cycle environments don't reward the same strategies that early cycle environments do.
To understand what may come next, we have to step back from headlines and look at history. Because while technology changes, political systems change, and currencies evolve, human behavior around debt does not. When long-term debt cycles reach their later stages, the pressure doesn't usually release in a calm, orderly way. It builds quietly over time, then resolves through some combination of recession, restructuring, inflation, or financial repression. Let's look at a few historical examples. In the late 1920s, the United States experienced a massive credit expansion. Debt levels rose rapidly. Asset prices, particularly stocks, soared. Optimism was everywhere. Leverage was widely used. People believed the system had become permanently stable. Then the cycle turned. Between 1929 and 1932, the stock market fell nearly 90% from peak to trough. Banks failed. Businesses collapsed. Unemployment surged. It wasn't just equity investors who suffered. Many bonds defaulted. Entire financial institutions disappeared. Now, that doesn't mean we're heading for another Great Depression. History never repeats exactly, but it does reveal how excess debt eventually destabilizes systems. Fast forward to the 1970s. This time, the problem wasn't a sudden crash followed by deflation. It was sustained inflation. Government spending had expanded. The Bretton Woods gold standard broke down. Oil shocks hit the global economy. Inflation surged into double digits. What happened to traditional portfolios? Bonds performed terribly in real terms. Rising inflation eroded fixed income returns year after year. The 10-year Treasury lost significant purchasing power throughout the decade. Stocks moved sideways for much of the 1970s. Nominal returns didn't look catastrophic at first glance, but after adjusting for inflation, real returns were deeply disappointing. Investors waited more than a decade just to break even in purchasing power terms. Then look at 2008, a different kind of debt crisis. Excess leverage in housing, complex derivatives, fragile bank balance sheets. When confidence cracked, liquidity vanished almost overnight. Markets dropped sharply. Correlations went to 1. Diversification didn't protect in the short term. Each of these episodes looked different on the surface, but underneath they shared one common thread: the end of an extended credit expansion. And in each case, traditional 60-40 portfolios faced significant stress, either through sharp drawdowns, prolonged stagnation, or inflation erosion. So the key question becomes, if we are indeed late in another long-term debt expansion, what tends to hold up better? Not perfectly, not magically, but relatively better. Across these historical cycles, 4 types of assets repeatedly showed resilience in preserving purchasing power. Again, this isn't a guarantee, it's pattern recognition. The first category is monetary hedges, primarily physical precious metals. Gold, in particular, has functioned for thousands of years as a store of value outside the credit system. It carries no counterparty risk. It cannot be printed. It doesn't depend on corporate earnings or bond issuers honoring obligations. In the 1930s, gold was revalued higher relative to the dollar. In the 1970s, gold rose dramatically as inflation accelerated. In the 2000s, during aggressive monetary easing, gold appreciated substantially again. Now, gold doesn't produce income. It can underperform for long stretches, sometimes decades. It's not a growth engine. But during periods of currency stress or negative real interest rates, it has historically acted as insurance. And insurance isn't meant to outperform in good times, it's meant to protect in bad ones. The second category is businesses with pricing power, not speculative growth stocks trading at extreme multiples, not companies dependent on cheap credit to survive, but businesses that sell essential products and can pass rising costs on to customers. Think about companies that provide everyday necessities, food products, healthcare supplies, utilities, energy infrastructure. When inflation rises, their input costs increase, but because their goods are essential, they can often raise prices without losing customers. That pricing power protects margins. In the 1970s, broad stock indexes struggled, but certain sectors, particularly energy and consumer staples, performed far better because revenues adjusted with inflation. The key difference isn't stocks versus no stocks. It's fragile growth versus durable cash flow.
The third category is short-duration government securities and cash equivalents. This one sounds unexciting, but liquidity becomes incredibly valuable during periods of stress. When markets decline sharply, assets don't just become cheaper, they become mispriced. Investors forced to sell create opportunity. Those who have liquidity can act. In 2008, high-quality assets traded at distressed prices because sellers needed cash immediately. In 2020, during the pandemic panic, markets fell rapidly before recovering. Liquidity provides optionality. It may not beat inflation long-term, but it reduces the risk of being a forced seller at the worst possible time. The fourth category is productive real assets. Assets tied to physical output, farmland, energy infrastructure, rental properties, logistics networks. Why do these tend to hold up? Because regardless of financial conditions, people still need food. They still need housing. They still need energy. Real assets produce income streams connected to tangible demand. During inflationary periods, rents and commodity-linked revenues often adjust upward over time. These assets can still experience volatility, especially if interest rates spike, but they are grounded in real-world utility, not just financial valuation. Now notice something important. None of these categories are about extreme bets. They're about balance. They're about shifting from maximum growth exposure to resilience exposure when the macro backdrop changes. Because late in long-term debt cycles, the objective often shifts from maximizing returns to preserving purchasing power. And that distinction can define whether someone retires comfortably or spends an extra decade rebuilding losses.
Now, understanding which asset types have historically shown resilience is only half the equation. The more important question is how to position intelligently, without panic, without extreme shifts, and without trying to predict exact turning points. Because one of the biggest mistakes investors make in late cycle environments is overreacting. They hear debt crisis and immediately think they need to sell everything, buy gold, and sit in cash, waiting for collapse. That approach usually backfires. Markets can stay elevated longer than expected. Growth can continue. Optimism can stretch well beyond what seems rational. And if you reposition too aggressively, too fast, you risk missing continued upside while sitting in defensive assets that move slowly. Preparation is not about going all in on one scenario. It's about tilting probabilities in your favor. Historically, investors who navigated late cycle periods more successfully didn't abandon markets entirely. They adjusted exposure. Instead of being heavily concentrated in broad index funds or speculative growth, they reduced vulnerability and increased resilience. One framework, not a rule, not a prescription, but a framework based on historical patterns, might look something like this. A modest allocation to physical precious metals, often in the range of 10 to 15% for those focused on capital preservation. This functions as monetary insurance. A larger allocation, perhaps 30 to 35%, to businesses with durable pricing power and consistent cash flow, companies that have survived multiple recessions, companies that can maintain margins even when input costs rise. A meaningful liquidity buffer, roughly 20 to 25%, in short-duration government securities or high-quality cash equivalents, not because cash is exciting, but because flexibility is powerful. And then a portion, maybe 10 to 15%, allocated to productive real assets that generate tangible income streams tied to essential needs. That structure doesn't eliminate risk. Nothing does. But it shifts the balance away from maximum sensitivity to asset bubbles and toward durability across scenarios. The exact percentages depend heavily on age, time horizon, income stability, and personal risk tolerance. Someone in their early 30s with stable income and decades ahead can afford more growth exposure. Time is their advantage. Someone within 5 to 10 years of retirement faces a different reality. Large drawdowns at that stage can permanently change outcomes due to sequence risk. This is where discipline matters more than prediction. Instead of asking, when will the crash happen? A better question is, if volatility increases or inflation persists, how exposed am I? Look at your portfolio objectively. If inflation averaged 5 to 7% for the next 5 years, which holdings would struggle? If equity markets declined 30 to 40% over 18 months, would you be forced to sell? If interest rates stayed structurally higher, how rate sensitive are your assets? These are stress tests, not forecasts. The goal isn't to assume catastrophe, it's to remove fragility. Another critical point is sequencing your transition. Gradual repositioning tends to outperform dramatic shifts. Start by reducing speculative exposure first. High valuation companies dependent on cheap capital are typically more vulnerable when liquidity tightens. Assets purchased primarily because of momentum rather than fundamentals deserve scrutiny. Then evaluate concentration risk.
Many investors don't realize how heavily exposed they are to a single index, sector, or theme until volatility hits. Rebalancing over 3 to 6 months instead of in a single day reduces regret risk. It allows you to average into defensive positions rather than trying to catch perfect entry points, because perfection is impossible. No one rings a bell at the top of a cycle, and late cycle periods can be the most confusing. Markets may continue rising even as underlying imbalances grow. Optimism can coexist with structural fragility. That's why emotional control becomes crucial. In every major downturn, three emotions dominate. Fear makes people sell at the bottom. Greed makes them chase at the top. Hope makes them hold positions long after the risk-reward has deteriorated. A systematic plan written down protects you from those impulses, not a vague intention, an actual plan. For example, over the next 4 months, I will reduce speculative exposure by X%, increase liquidity by Y%, and build exposure to durable cash flow businesses. Clear, measured, structured. Because in volatile environments, clarity beats confidence. There's another misconception worth addressing. Positioning defensively does not mean assuming collapse is guaranteed. There are scenarios where high debt levels resolve gradually. Productivity breakthroughs can offset imbalances. Policy coordination can smooth adjustments. Inflation can moderate without deep recession. Those are possible outcomes. But when debt to GDP ratios are historically elevated and interest burdens rise, the distribution of outcomes widens, volatility increases. And in wide outcome environments, robustness outperforms precision. It's less important to guess the exact path, more important to survive multiple paths. That mindset shift from maximizing returns in ideal conditions to maintaining resilience across uncertain conditions is what separates long-term wealth preservation from cyclical gains. Because the real danger in late-stage cycles isn't just market decline. It's complacency built on the assumption that past decades will repeat exactly as they were, and financial history suggests they rarely do.
There's another layer to this that most people overlook. Late-stage debt cycles don't usually begin with panic. They begin with normalization. High debt becomes the new normal. Large deficits become routine. Rising interest costs are described as manageable. And for a while they are. Economic systems are remarkably adaptive. Governments refinance, central banks adjust policy, markets stabilize, growth continues even if slowly. That's why late cycle environments are so deceptive. Nothing feels broken until suddenly something does. Credit markets tighten, liquidity dries up, a large institution faces stress, or inflation reaccelerates just when policymakers thought it was contained. The trigger is rarely obvious in advance, but the vulnerability builds quietly. And this is where most traditional portfolios reveal their weakness. The classic 60-40 model was designed during a 40-year period of declining interest rates. Bonds provided income and price appreciation as yields fell. Stocks benefited from expanding valuations supported by cheap capital. But when rates rise from historic lows, bonds behave differently. When inflation becomes less predictable, correlations shift. Diversification doesn't always protect in the short term the way investors expect. Again, that doesn't mean the model no longer works. It means the assumptions behind it must be re-examined in the context of the current macro backdrop. This is why liquidity and pricing power become so important. Let's talk more specifically about pricing power. In inflationary or unstable monetary environments, businesses that cannot raise prices see their margins compress, their costs increase, but their revenues remain fixed. Profits shrink. Companies dependent on discretionary spending can also struggle if consumers tighten budgets. But companies selling essentials, energy, food, basic healthcare, utilities operate differently. Demand is less elastic. Customers may complain about higher prices, but they still purchase. The ability to protect margins in inflationary environments creates a buffer. It's not about finding the fastest growing company, it's about identifying durable cash flow. Similarly, real assets tied to tangible needs create resilience because they are grounded in physical demand. Farmland produces crops regardless of stock market sentiment. Rental properties generate income as long as occupancy remains stable. Infrastructure assets, pipelines, utilities, logistics networks often operate under long-term contracts. These assets are not immune to volatility. Rising interest rates can pressure valuations. Economic slowdowns can reduce occupancy or throughput. But over longer horizons, tangible assets tied to essential services tend to reprice with inflation.
Contrast that with long-duration financial assets whose value depends heavily on discount rates and future expectations. Late-cycle environments tend to compress optimism. Valuations matter more. Cash flow matters more. Balance sheet strength matters more. That's why stress testing your portfolio becomes critical. Ask yourself, if markets experienced a 30% correction, which holdings would you feel confident holding for 5 years? If inflation stayed above central bank targets longer than expected, which assets would protect purchasing power? If credit conditions tightened and refinancing became more expensive, which companies in your portfolio could still operate comfortably? These are not hypothetical scare tactics, they're scenario planning. The goal is not to eliminate risk, it's to eliminate fragility. There's a difference. Fragility is when a single shock forces permanent damage. Resilience is when volatility becomes uncomfortable, but survivable. And survivability is what ultimately compounds wealth. One more important point, timing transitions requires emotional maturity. During late cycle phases, markets can continue rising even as imbalances grow. Liquidity may remain supportive longer than expected. Optimism can stretch valuations beyond what seems reasonable. If you reposition gradually and markets rise for another year, you may feel like you acted too early. That discomfort is normal, but preparation isn't about maximizing every final percentage of upside, it's about reducing asymmetrical downside, because recovering from a 50% loss requires a 100% gain. That math never changes. Especially for investors approaching retirement, drawdowns are not just temporary setbacks, they alter future income, lifestyle flexibility, and optionality. And optionality is one of the most valuable assets in uncertain environments. Liquidity gives you optionality. Cash flow gives you optionality. Low leverage gives you optionality. High concentration and high leverage remove it. When cycles turn, optionality separates forced sellers from strategic buyers. Throughout history, the investors who emerged strongest from crises were rarely the most aggressive during the boom. They were the most liquid and the least fragile when stress arrived. And often, they didn't look extraordinary during the final phase of expansion. They looked cautious, until caution became wisdom. Right now, we're in a phase where confidence remains relatively high. Markets have shown resilience. Policymakers project stability. Economic data sends mixed signals. But debt levels remain elevated. Structural imbalances remain present. Interest burdens are no longer negligible. That doesn't guarantee crisis. It simply means the margin for error is thinner. And when margins are thin, prudence becomes valuable. Not panic, not prediction, prudence. Because the objective isn't to win the final year of a cycle. It's to protect the next decade of your financial life.
And this brings us to the most important part of all of this, not the macro theory, not the historical charts, not even the asset categories, but behavior. Because in every major cycle shift, the deciding factor isn't information, it's action. Most people understand risk only after it materializes. They feel safe when markets are rising. They feel intelligent when their portfolio is growing. And they assume stability will continue because it has continued. Then volatility arrives and suddenly the conversation changes. But by then, positioning is reactive instead of proactive. The purpose of understanding long-term debt cycles isn't to predict collapse, it's to recognize when risk-reward dynamics shift. In early cycle environments, growth exposure is rewarded. Liquidity is abundant. Risk-taking pays. In late cycle environments, balance sheet strength, pricing power, and liquidity matter more. The shift is subtle at first. Then it becomes obvious. And once it becomes obvious to everyone, repositioning becomes expensive. That's the window most investors miss, not because they lack intelligence, but because change is uncomfortable. Reducing exposure when markets are calm feels unnecessary. Holding liquidity when others are fully invested feels inefficient. Allocating to defensive assets when growth stocks are rising feels conservative, until it doesn't. And here's something else that matters. Advisors, media outlets, and financial institutions often operate within structural incentives. Investment firms earn fees on assets under management. Financial media thrives on engagement, which often amplifies optimism during bull markets and fear during crashes. That doesn't make them malicious, but it does mean you must take ownership of your positioning. No one will care about your retirement timeline more than you do. No one will feel the impact of sequence risk more than you will. So here's a practical approach. Open your portfolio, not casually, not abstractly. Look at each position. Ask yourself one simple question. If we entered a period of sustained inflation, tightening liquidity, or heightened volatility? Would this holding protect purchasing power, or would it depend on continued expansion? Be honest. If a position depends entirely on optimistic growth assumptions, cheap capital, or expanding valuations, recognize that. It doesn't mean sell everything immediately. It means evaluate concentration and exposure, then create a structured plan, not emotional reactions, not dramatic shifts, a written plan. For example, over the next 3 to 6 months, gradually reduce speculative positions, increase allocation to durable cash flow businesses, build a liquidity buffer, introduce or modestly increase exposure to monetary hedges or real assets if appropriate. Measured steps, not overnight transformation, because the goal is balance, not extremism. Another key principle is maintaining humility. No one knows exactly how the next phase unfolds. Inflation could moderate, growth could surprise to the upside, technological innovation could offset structural debt burdens, or volatility could increase. A resilient portfolio is built to handle multiple outcomes. It's designed not just for the scenario you fear, but for the scenario you didn't anticipate. That's real diversification, not just spreading capital across asset classes, but spreading exposure across economic conditions. The mistake many investors make is assuming the future will resemble the most recent past. For decades, falling interest rates supported both stocks and bonds simultaneously. That environment shaped conventional portfolio construction. But if we've shifted into a structurally different regime, one with higher baseline debt and less room for policy maneuvering, then positioning may need to adapt gradually, rationally, without panic, because wealth isn't destroyed only by crashes. It's also eroded quietly by inflation, poor risk management, and overexposure to a single narrative. The people who preserve wealth across generations are rarely the most aggressive at the top. They're the most disciplined across cycles. They understand that prosperity creates excess. Excess creates vulnerability. Vulnerability eventually forces adjustment, and preparation before adjustment is far easier than repair after it. If nothing dramatic happens and the system stabilizes smoothly, a resilient portfolio still compounds, maybe not at the absolute maximum rate, but steadily. And if volatility does increase, if liquidity tightens or inflation reaccelerates, resilience becomes priceless. At the end of the day, this isn't about predicting disaster. It's about respecting cycles. Economic history stretches back centuries, and while technologies evolve and markets modernize, leverage and human behavior remain constant. Debt expands, confidence builds, risk is underestimated. Then the cycle turns, sometimes sharply, sometimes gradually, but it turns. The only real question is whether you're positioned to endure that turn without permanent damage, because survival in investing isn't dramatic, it's discipline, and disciplined positioning, especially late in long-term cycles, is what transforms uncertainty from a threat into an opportunity, not because you guessed perfectly, but because you prepared intelligently, and that difference, over the span of a financial lifetime, changes everything.